Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. My name is Sava, and today we're finishing our journey through the realm of option trading strategies with the final bit, low volatility strategies. In the last 3 videos, we discussed what to do if you believe that the stock prices will go up, if the stock prices will go down, by a lot, by a little. And in the most recent video, we also discussed high volatility strategies that are neutral in direction. What should you do if you are sure that the stock price will change a lot, but you are unsure about the direction? But that doesn't cover all potential sets of beliefs that an investor might have about future stock price movements. And an investor might believe that the stock price would not change much over the course of the investment period, that it will remain stable. And that is characteristic of some of the more well-established companies, value stocks, blue chips. And one of the most famous examples of such a company is Caterpillar. That's an industrial company that's listed on the New York Stock Exchange, that is a constituent of Dow Jones Industrial Average. And this company is actually sometimes used by the analysts as an indicator of forward-looking economic performance, whether there's going to be a recession or not. This stock is believed to be extremely defensive and believed to be extremely rigid and respond a little to overall stock market movements. So that stock would be perhaps the best example to discuss a low volatility strategy. Well, if you imagine the payoffs of straddles and strangles that we discussed in the last video, you might think, well, if we longed a call and a put at the same strike price in case of a straddle, and we had infinite upside when the prices went extremely up or extremely down, and we had fixed downside when the prices stay roughly the same, why not just short a call and a put simultaneously and then grasp some payoff when the prices stay within this narrow range? Well, that would be called a short straddle, and that is by all means a strategy that can be used. But if you think about the payoff of a straddle, you have infinite upsides at the tails, so on the extreme positive movements of the stock price and the extreme negative movements of the stock price. So by analogy, if you have a short straddle, so you convert that type of a payoff chart to that type of a payoff chart, you would have infinite downside. If prices break out of this narrow range determined by the initial strike price and the option premium of the calls or puts that you shorted. But there is a very neat tool, a very neat option trading strategy that could allow you to take advantage of this logic of the short straddle, but also limit the downside by also longing options at other strike prices. So this strategy is called a butterfly. The butterfly strategy involves shorting 2 calls or 2 puts at the strike price that is as close to the center price as possible, so just as it would have been in the case of the short straddle, with the only exception that you short either 2 calls or 2 puts, not a call and a put. And then you also long 2 calls or 2 puts for the strike prices that are in the money and out of the money respectively. So in case of the butterfly strategy using calls, you would long 1 call that is in the money, so with a strike price that's lower than the center price, and 1 call option that is out of the money with the strike price that's higher than the center price, than the share price at the start of your investment period. What it would do is that it would limit your downside. And for the payoff of the butterfly strategy to be symmetric, so that you lose exactly the same fixed amount regardless of whether the share price moves up or down, the wings of the butterfly, so the distances between the center price, the strike price of the call option that you are shorting, and each of the strike prices of the call options that you are longing should be exactly the same. In our case, let's investigate the Caterpillar stock as our underlying and As a trading period, let's consider a very short-term trading period starting on the 24th of December 2019, so right before Christmas, and with a maturity date of 17th of January 2020. We can see at the start of the investment period, the stock price was $147.48, so closer to $147 than $148. That would dictate the fact that our strike price for the call options that we would short for the center of our butterfly, for the body of our butterfly, would be 147. So we indeed short two call options in Caterpillar at the strike price of 147, and we receive the option premium of $3.3 per share per one call options that we short. And to pick the length of butterfly wings, well, first of all, we have to make them equal again, so our payoff, our fixed downside, does not depend on whether the share prices goes up or down, but also this range should reflect our forecast. What are the boundaries that we believe the share price would not fluctuate out of? We could estimate them using technical analysis, for example, using lines of support and resistance, if you want. You could use fundamental valuations, some conservative or less conservative fundamental valuations to determine those boundaries, or you could just use standard deviations of the returns of the stock in specific time periods to determine these likely boundaries the stock price would not breach within your investment horizon. So in our case, let's assume that the lower bound, the strike price of the in-the-money call that we are long in is 144, and we have to pay $5.35 per share for this long call, and our long call out of the money is $150 per share as a strike price, and the premium is $1.9 per share. So we can see that the length of one wing of our butterfly is going to be $3, and the distance from 144 to 147 is exactly the same as the distance from 150 to 147. So our payoff structure would be symmetric, and that's exactly what we need, because the butterfly strategy is a low volatility neutral strategy. We believe that the stock price would not go in any direction, it will stay roughly the same. So without further ado, let's calculate the net payoffs of all of those options and calculate the total payoff of our butterfly using calls. And quite fitting, we are now calculating the butterfly for the Caterpillar. So very fitting overall. For the net payoff of our two calls that we short, we need to estimate the gross payoff first. So if the call option is in the money, so the share price is lower than the strike price, then call options are not exercised, and we are happy because we receive the premium for the options that we've written, and we don't have to exercise anyone's rights, so 0. But if the call options move out of the money, then our counterparties have the incentive to exercise their options, so they have the incentive to exercise the right to buy Caterpillar from us at 147. So we, in turn, have to buy it at the market for a higher price and sell it to them at 147. So we receive 147 and we pay the market price, which is by definition higher. And because we have shorted two calls for Caterpillar, we need to multiply the gross payoff that we receive by 2. And then, because that's a short call, to move from gross payoff to net payoff, we need to add the option premium and again multiply by 2, because we have shorted two call options instead of one. And that would give us the payoff of two short calls. Now, for the payoff of a long call at those two various strike prices, we could implement a neat technique that would allow us to just drag the formula around in Excel and would allow us not to input the formula every single time for every single option, because, well, both long calls have exactly the same logic. They have various premia and various strike prices. To accommodate for that, we need to type in the following. If the share price, and then we need to lock the column because we would drag it to the right, and therefore we don't want the column to change, but we want the row to change for different simulations in different share prices. If the share price is lower than the strike price, and here we just need to lock the column, because we want the strike price to change as we consider various long calls, but we don't want the formula to refer to different cells at the same column, because the strike price is the same for one option. So again, if the call option is in the money, then the gross payoff is 0. And when it moves out of the money, that's the long call that we are holding. So we are the one that exercising it. So we can buy Caterpillar at 144 and sell it for a higher price on the market. So the market price, and again, we lock the column minus the strike price, and here we lock the row. Here we don't need to multiply by anything, but because we just long one call option at this particular strike price. And then, as that's a long call, and we have to buy it, so we have to pay the premium, we need to subtract the option premium. And in case of the option premium, we still just need to lock the row, not the column, because we want the premium to change as we move from option to option. And that logic of Excel formulas allows us to drag this formula both to the right and figure out the payoff of both long calls at various share prices, and bottom right click it all the way down to simulate the payoff structure. And as we can see, if none of the options are exercised, so all of the call options are in the money, the payoff that we receive is formed only by the combination of option premium we pay and receive. And due to market equilibrium reasons, the sum of the premium of the long calls that we have to pay should be greater than the sum of the premium for short calls that we have written. Because if that wasn't the case, the butterfly strategy would allow us to obtain riskless profit. And that is something that is unsustainable on a real-world financial market. So without further ado, we can just calculate the total payoff of our butterfly strategy by summing up the payoffs of all options that go into our spread, our option portfolio, as usual. And we can see that if the share price fluctuates out of the narrow range that we've determined by the strike prices of the calls that we long, we have a fixed downside instead of the infinite downside that would have been provided by the short straddle, the simple short straddle. And this fixed downside is relatively small, just 65 cents per share. And as we are moving up, we can see that as we break through the strike price of our in the money call option, our payoff starts increasing, and it increases until it reaches the maximum at 147, the strike price of the call options that we shorted. Then, symmetrically, it starts decreasing until it again hits negative 65 cents per share as it reaches $150 per share, which is the strike price of our out of the money long call. That allows us to design this very symmetrical and bounded from both sides payoff structure that guarantees us limited positive payoff if the prices stay roughly the same, and fixed negative downside if the prices fluctuate out of this narrow range that we determined by selecting the initial strike prices. If we look at the graphical representation of the butterfly, we can see that this is the overall cumulative payoff chart. We can see that at the very tip of the graph, we are obtaining the maximum payoff, $2.35 per share. How this payoff is generated, what factors into this payoff, why the payoff of the butterfly is as it is. Well, if we talk about call options, we already know that none of the call options are exercised in the money. So when all of the options are in the money, when the share price is below $144 per share, then all of the payoff curves are flat. So this is the payoff curve for the two short calls that we've written. Those are the payoff curves for the two calls that we've longed, two calls that we've bought. So the payoff is determined just by the sum of the premium, positive or negative, of those options. And due to equilibrium reasons, and we can see it clearly from the chart, the sum of the payoffs, the sum of the premium that we have to pay should be higher than the sum of the premium that we receive by shorting the two calls. So this is what generates this fixed downside. Then, as we break through 144, the strike price of the very first long call that we've bought, we have one payoff curve of the long call creeping up, but all other payoff curves still stay flat because we haven't broken through their strike prices. So our payoff chart just increases $1 at a time with $1 increase in the share price until we reach the strike price of our short calls, 147. As we reach 147, we will have one long call payoff creeping up and two long call payoffs creeping down. On net, we would have one negative short call payoff creeping down. So our payoff would decrease $1 per $1 change in the share price until we get to 150, the strike price of our final long call. And because we have chosen the wings of our butterfly to be symmetric, to be of the same length, that is what guarantees that those 2 points, the strike price of 144 and the strike price of 150, lie on the same height. They guarantee the same fixed downside of $0.65 per share. And as we reach 150, we will already have two payoff curves of long calls creeping up and two short calls creeping down. So on net, the variability will be eliminated, and our payoff chart of the butterfly all the way from 150 and above would be just flat. That is what makes the butterfly payoff as it is. But we don't really need to use calls to get this butterfly payoff chart. We could create exactly the same risk structure and payoff structure by using puts instead. So whenever we would have longed or shorted a call, in case of the butterfly with calls, we could do with puts with exactly the same logic. Let's proceed with that. We need to short two puts at the strike price that's equal to the center price or as close to the center price as possible, and then long two puts that are in the money and out of the money, and apply the very same logic of short and long puts and see where it will take us. So in case of two short puts, if the share price is lower than the strike price, then our counterparty has the incentive to exercise their short puts. They have the incentive to sell the stock of Caterpillar to us at $147 per share. So we have to pay that to them. And what we can sell it for is just the market price. That's lower than the price that we have just paid to our counterparty because we couldn't say no to them. So our payoff is the market price minus the strike price. So our payoff of the short put would be negative. And if the put option moves out of the money, then we are, as the issuer has the right of the short put, we are happy because we've got the premium but didn't have to provide anything in exchange for that. So the gross payoff is zero. And because we have shorted two puts, we just have to multiply by 2. And as that's a short option strategy, we would have to add the option premium of the put times 2. And then we can figure out that our net payoff of the two short puts, if the share prices go down, would be very negative, ever increasingly negative, potentially infinite, because as the share prices go down, the payoff of any short put decreases indefinitely. What happens in case of long puts for those two strike prices? Well, let's again apply the same logic of locked Excel cells to just input the formula once. So if the share price, and we need to lock the column, is lower than the strike price of this long put, then we can exercise this long put. We can sell Caterpillar at 144, having bought it for just the market price on the market and get positive payoff from that. And if the put option moves out of the money, we can no longer exercise it beneficially, so 0. And as it's a long put, we have to subtract the option premium, as that's the premium we have paid that we had to provide to our counterparty to guarantee this optionality for us. And now what we can do is we can just drag this formula to the right and get the payoff of the second put option as well. And also we can bottom right click all of those three net payoff functions to get the payoffs of them alongside the diapason of the share prices we want to investigate. And the total payoff of our butterfly using puts would be just the sum of the three of those three payoffs. And what we can see here, even from the numerical expressions of total payoffs of those two strategies, is that the total payoff of the butterfly strategy using calls is always 9 cents per share lower than the respective payoff of the butterfly strategy using puts. That reflects mispricings on the option market. So if you are considering a butterfly strategy, you always have to consider various types of the option strategies that are equivalent in terms of risk structure and payoff structure, but due to the fact that options are not perfectly priced, might provide you with relatively better payoffs. In that case, the payoff of the butterfly strategy using puts is objectively better than the payoff of the same strategy using calls. To look at that graphically, we can see that the comparison of the two charts is the following. This is the payoff of the strategy using calls, and this is the payoff of the strategy using puts. As we can see, for every single share price that the share price of Caterpillar can take potentially, the payoff of the butterfly strategy using puts is higher. So any rational investor would choose puts instead of calls if they are considering the butterfly strategy. Theoretically, what would happen on the market is that it would put additional selling pressure on puts at center prices. That would drive the premium down, and it would drive the premium of the butterfly strategy using puts down, and it would put additional buying pressure on long puts at the wings, so at the strike prices that are equidistant from the body of the butterfly, from the center price. So that would correct the relative payoffs of the butterfly strategies in calls and puts, and that type of arbitrage and market movements would equilibrate the payoffs of those two strategies eventually. But as a single investor, you shouldn't care about it too much. You should just consider various strategies that deliver the same payoff in terms of the risk structure to you, and choose the one that is objectively better. If we try to consider how the butterfly strategy using puts arrives at that relatively attractive payoff structure, we should consider first what happens when all of the put options are out of the money. If all of them are out of the money, so we are going to the left from the very extremely positive share price movements closer to the center price, we can see that none of the put options are exercised out of the money. So everything that would contribute to our total payoff of the butterfly strategy would just be the premium, the sum of the premium that we pay and receive. And again, due to equilibrium reasons, this sum should be negative, and that's why we have this negative payoff, this fixed downside if the share prices fluctuates out of the narrow bound that we have determined by the initial strike prices of our puts. Then, as we move beyond 150 to the left, we have one of our long puts being already exercisable. So our long put at the strike price of 150. So as we move from the strike price of our initial long put, so 150, all the way to the strike price of our short puts, so 147, we would have our payoff increasing by $1 with $1 decrease in the share price. So that's exactly what happens until we reach 147, the strike price of our short puts. All the way from there, if we move further to the left, we can see that we'll have one long put creeping up and two short puts creeping down. So on net, we would have our payoff decreasing by $1 with every $1 decrease in the share price. So that's exactly what would happen until we reach the strike price of our final long put at 144. At that point, all of our put options would be exercisable, and we'll have two long puts creeping up and two short puts creeping down, so the variability would be eliminated, and on net we would be left with a fixed downside of roughly 56 cents per share. And why the downside is symmetric? Well, because we have again selected the length of our wings, the wings of the butterfly, to be equal. The strike prices of long puts being equidistant from the strike price of the short puts. Well, we can see that in case of the butterfly, regardless of calls or puts, we grasp the maximum payoff only at one single spot, when the share price is exactly equivalent to the strike price of our short calls or short puts. And if the share price moves even a cent to the left or to the right of this center price, then we start losing. Our payoff starts decreasing. To avoid that, there is a modification of the butterfly strategy that's called Condor. In case of the Condor, you do not short two calls or two puts at exactly the same strike price, but you pick a flat plateau of sorts between the strike prices of your short call and short put. So, for example, to modify our butterfly into a Condor, we could make a Condor out of call options and consider a Condor based on calls with short calls at 145 and 149 instead of two calls coinciding at 147. What that would do is that it would eliminate the variability of the payoff between 145 and 149, and that would mean, that would secure that we guarantee maximum possible payoff within the range of share prices, that if the share prices do not fluctuate outside of this boundary. And this is like the spine, the body of the Condor, which is much thicker than the body of the butterfly, because again, a Condor is much of a larger beast than a butterfly is. So that's the logic between the naming of the two creatures. The other analogy in terms of the Condor I'll show you as soon as we look at the payoff charts. So, without further ado, we need to just calculate the payoffs of the short calls, 145, 149, that are again symmetric in terms of the initial center price of 147. And we also need to pick the wings of the Condor as the two strike prices for long calls. That's very analogous to the process that we used when constructing the butterfly. The length of each Condor's wings should be exactly the same. So the strike prices of the long calls should be equidistant from the strike prices of the respective short calls. In that case, we have picked the in-the-money long call at the strike price of 139, and out-of-the-money long call to be at the strike price of 155. It means that the length of each of our wings, or the wings of our Condor, are $6 each. So one wing, the left wing, is from 139 to 145, $6. The right wing is from 149 to 155, again, $6. That would again guarantee that the payoff structure of our Condor is symmetric. So in case of the short call, again, we have two short calls here, so we can apply the very same logic that we already did. If the share price, and we lock the column, is lower than the strike price, and we'll lock the row. So if the call option is in the money, then our counterparty doesn't want to exercise that, and we are happy, and the gross payoff of this short call is 0. If, on the other hand, the call option moves out of the money, our counterparty wants to exercise it. They want to buy Caterpillar from us at 145 per share. So we have to sell it to them at $145 per share. So that's what we receive. But what we have to pay for getting the stock at the first place is the market price, which is higher. So that's why the gross payoff of the short call in that case would be negative. And then, as it's a short call again, we need to add the premium, because that's what we receive for writing the option, for taking on the risk. So add that and lock just the row. And we can drag that and apply the formula for both short calls. In case of the long calls, we already have the formulas for any long call for any strike price and any premium written over there. So we could just copy those two cells and paste them over here and get correct payoff structures calculated automatically. Just for the sake of the fact that we have locked correct rows and columns. Please do follow this procedure as well when you have lots of various payoffs to estimate and you want to save time. Now we can just bottom right click this function and see how the payoffs of those long and short calls change with time. and figure out the total payoff of our Condor, which would be the sum of those 4 payoffs. Again, the total payoff of the option portfolio is just the sum of the net payoffs of all of the options that go into that. So over here we can see that we've got fixed downside of minus $4.7 per share if the share prices fluctuate wildly out of the boundaries we have predicted. Then, as we pass through the initial strike price of our long call, which is 139, so we pass through 139 and our payoff starts creeping up. And then, as we pass through the wing, so we climb onto the left wing on the Condor and we climb onto the spine of the Condor at 145, we start receiving the maximum payoff possible, $1.3 per share. And this payoff at this plateau remains exactly the same all the way until we reach the right wing of our Condor, the 149 strike price, the second strike price of our short call. And then our payoff starts decreasing as we climb down the right wing of the Condor, and then it remains fixed since we have passed through 155. That's the final strike price of the long call. And because the wings of the Condor that we've constructed are of the same length, they are equidistant from the center prices, they are $6 each. The payoff structure is symmetric. We are losing the fixed amount, and this fixed amount is exactly the same, minus $4.7 per share, regardless of whether the price moves extremely to the right or extremely to the left. If we look at the graphical representation, we can see this plateau being formed in case of the Condor. And here the logic is very similar. As none of the options are being exercised, variability is eliminated, we have fixed downside. Then, as we pass through 139, the first strike price of the long call, we start creeping up. Then we have one short call kicking in at 145, the start of the body of our Condor on the left hand side. Then we have one long call creeping up, one short call creeping down. That would mean that our variability is again eliminated and we have fixed payoff, fixed positive payoff all the way until we get to 149. That's the right hand side of the body of our Condor. And then we start getting negative payoff from our second short call at the strike price of 149. So then we have two short calls creeping down and one long call creeping up. So again, we would have one short call creeping down on net. So our payoff will be reduced by $1 per share with every $1 increase in the underlying share price. And that would continue all the way until we reach the end of the right wing of the Condor. And by the virtue of the fact that our wings are of equal length, the payoffs are symmetric regardless of whether the price moves extremely to the right or extremely to the left. The final thing that we would consider today is the strategy that implements the Condor spread using puts. The logic is exactly the same, it's just that we have to short two puts at the strike prices that are close to the center price and are equidistant from it roughly, and we have to long two puts to specify the wings of our Condor. And here we will choose exactly the same strike prices, we will just choose puts instead of calls. And we can see that the premium for the puts and calls change respectively. We can see that again the logic is preserved, that the higher strike price means a more valuable put option and a less valuable call option, which stems from the fact that it's more valuable to buy something cheap and it's more valuable to sell something expensive. Now for the payoff of the short put, we can implement exactly the same logic. If the underlying share price, and we need to lock the column, is lower than the strike price, and here we need to lock the row, then our counterparty has the incentive to exercise their put option, so they have the right to sell Caterpillar to us at 145, and then we can just sell it on the market for a lower price. So we receive the market price, and we have to pay the strike price. So that's why our gross payoff, if the short put is in the money, is negative. And if the short put moves out of the money, the gross payoff is 0, and we're happy about it because we have received the premium. Now we can drag it to the right and implement the very same logic for another short put with a different strike price and premium. And then we can implement the very same logic for the long puts, because remember, we have written the same formulas for our butterfly spread. So we can copy those, paste them over here, and then we'll be able to bottom right click the functions for all 4 options that go into our spread. Now we can sum up the 4 net option payoffs that go into our spread and see that indeed the risk structure of our Condor has not changed. We have fixed downside when the price goes down, limited upside when the price stays roughly the same, with this nice plateau of 2.75 dollars per share when we are at this body of the Condor between the 2 strike prices of the short puts. And then it starts decreasing again, and it reaches minus $3.22, which is exactly the same than our fixed downside when the prices went significantly down. If we look at this graphically, we can see that the logic is exactly the same, but slightly reversed to the logic of the Condor using calls. So we have various amounts of put options being exercisable either by us or by our counterparty at various strike prices. So our payoff chart is either flat, variability is eliminated, or it's creeping up or down depending on how many short or long puts are exercisable at every single strike price. And comparing the 2 payoff charts, we can see that again the total payoff of the Condor spread using puts is always significantly higher than the total payoff of the Condor spread using calls. And here the difference is much greater than in the example of the butterfly. We could earn a riskless profit of almost $1.5 per share by moving from a Condor with calls to a Condor with puts. By no means it's always the case. Sometimes spreads based on calls are more effective and they have objectively better payoffs. That's just the lesson that you have to learn, that you always should look for the best strategy available if you have a number of equivalent strategies that you can consider. And that's all for low volatility strategies, and I'm afraid we have covered all basic and even advanced option strategies together in this short series of videos. Hope it has been helpful to you. Hope this topic in investment management and derivatives was at least relatively exciting to you. If you would like to see some more content regarding other types of derivatives or more advanced content on options, please leave your suggestions in the comments below. As for now, don't forget to leave a like under this video, subscribe to our channel, and stay tuned. Thank you very much.